Alrighty, Doc here from North America. Good morning, good afternoon, and good evening. Let's see how they are rolling today. A little firmness again in the stocks like yesterday, and then they knock them down. I guess, or was it the other way around? Either way, they got firm again. Mr. Powell is speaking to Congress again, and he's basically saying the opposite of everything what Mr. Biden is saying now that he's been appointed. But it's kind of like too late. They've allowed the inflation to expand and grow, and now we have to slow our economy down to get some control of it. Obviously, the policies themselves won't shift until January, so at this point in time, we're just kind of watching the whole marketplace kind of stumble and tumble and not really have a lot of enthusiasm. Don't see the enthusiasm. I'm sure there'll be a little buying here or there, but overall, it really comes down to the fact that the markets are just cruising along. That's really what it comes down to. Nothing more than that. All right, let's get the J4X up there. There it is right there. That was yesterday looking at the Nat Gas. Let's take a look at the dollar index and see what's going on there this morning. Let's see, where's that at? Right. It's around here somewhere. There it is, dollar index. You can see it's been pretty much sideways too. It's been very tight. We're kind of already down at the low end of the range. Looks like it's trying to lift up. Does that mean the dollar is going to get stronger again? You can see it here this morning. It is above. It was above, closed yesterday, right there, above. Let's widen that so you can see it. So you can see that. And we had a red and a green, and this morning, coming in, we're basically in the buy again after dropping into the sell there. How come the line is not there? Let's see what that, there it is. Line, and then let's put the buy in there. There's the buy. Like that. There you go. And the weekly's been holding up pretty firm in here. Seems like they've pushed this down a little bit, but we didn't spot that, or it changed. Some data must have changed. We'll have to go back and look at the data in here just to double check it. So the dollar is firm, up towards its highs. You can see when we scrunch this chart up, that's pretty much the highs of a long while ago. See? Really a long while ago. So that's basically in 2020 right there. That's March of 2000. There's April of 2021. So this product has been slowly climbing. They don't seem to be able to stop the march of the dollar. And as much as we keep on hearing about problems, the end result is that they still buy dollars, and the pairs trades seem to be more in favor of a dollar overall. Probably because of higher interest rates, more solid. I can't say it's more solid guarantees that they're going to get their money back. They know they're going to get their money back when they buy government bonds, because the bonds, they'll give them dollars, and so that automatically happens. Hey, Robin. Hey, Jordan. So that's probably why they do lean into buying the dollar, and at the same time buying the bonds, and just being invested here. Europe, second largest economy in the world. The European Union, they're having some problems figuring out how to, perk up the European Union or individual countries. I guess, different states in the European Union. We see that even the stocks this morning. I saw the DAX down, I saw the CAC 40 up, and I saw the FTSE up. So they're kind of mixed markets going on there. All right. So there's the dollar index. Oh, what do we got here? Hey, gentlemen. Cool. So at this point in time, let's jump over to one of the pairs trades if nobody wants to see anything particular. Let's start off with the Swiss and see what the Swiss looks like this morning. There it is right there. It's been working its way down. See a little turn trying to turn here. That turn is trying to turn up. And let's take a look at it over on Chicago Quant. right there. All right, and it's trying to do the same thing. It's trying to turn up. Got lots of red there. What's that? 5 out of the last 6 days it's been red. You can see here, same basic situation right there, and it's trying to turn up, and we have the same thing going on right there, trying to turn up. So it looks like they're trying to reach in. We got the Swiss and just a weekly sell for 1 week. If there is buying, it will push the product back into the buy again. It's kind of interesting. We've gone sell, buy, sell, and no real consistency there whatsoever. I guess if any consistency, it's that the weekly keeps on flipping back and forth. All right, from there we'll jump over to the. Let's see, where's it at? Let's take a look at the European Union and the euro, the second most actively traded currency on the world, with the second largest economy in the world after America. You see, it's flipped into the under the zero line. So in other words, the weekly is trying to pressure down. Has been in a buy from here. It has really not gone anywhere. It's just sideways action, and they're pressuring it again here on a Thursday. Initial jobless claims come out. 229,000 actual versus 227,000 estimated. So pretty much in line there. That's not too bad. Okay, there's the euro right there. See, that's trying to roll over also right there. Just like we're rolling over right there. I thought Powell's had some real good conversation. I really do. Yeah. He's finally now able to speak in real terms. He's able to talk about real issues. He's able to contradict Mr. Biden's statements now that he's been appointed. At least, as far as I'm concerned, the only reason that the inflation got out of hand is that the administration allowed it to get out of hand. That's about it. I mean, really, they just have done what they can do to hurt things. We're looking at a 10-year bond yielding at 303. They've come down from 350. So, I guess we're at what, 1.5, 1.75 now on the Fed rate, and they says it's going to do another 3/4. So that'd be 2.5, 2.25 to 2.5, and then if he does a third one, that'll put it to 3, and that's probably why the money itself is not really going after 4%. They probably figure that by the time that's all played out, the election will be at its end or getting close to being at its end. And so, we got a late July number, then we have a mid-September number, and then from there it's almost November. So, maybe they'll pause for the November, we'll see what the election does, and then they'll take it on from there, because what will make the Fed comfortable probably is knowing that the policies that Washington has been projecting and trying to do will be stalled. And if the election turns out well for one side, then those things will be stalled. It'll be over with. The nightmare could come to an end, and we'll see 2 years of basically a quiet government with no wild spending anymore. And that's probably going to be the answer to it all. All right, from there we go over to the cable. Let's see what the cable's doing. There's cable. Still holding up in the buy, but by the hair of its chinny chin, as you can say. Just minus by a little. You see here it's in the zeros. 0.00016 just dropped from 17. So it's nice and tight. Now it's 15. We'll see if this holds up throughout the day. You can see they took it down and brought it back up a little bit. You see that weekly is amazing with the Chicago Quant. It just refuses, since the 130 area, it's found its way down to the 120 area. And it tried to change directions, but just wasn't able to do it. From there it is on J4X. You can see the cable again. And there it is there. You can see that pressure 2 days with it trying to turn down. Where'd the buy go? And buy was right here, just like the way the euro was. There we are. So we've been in the buy 2, 3, 4, 5 on a 6 day. That day there was a red and a green right there. That's why it didn't go into the sell. And now today it's right on the edge. And cable has been kind of fascinating. They've seemed to have tightened up the policies in England, getting more back into business, I guess you could say, getting back into the groove. That has been somewhat of a disappointment. We understand Europe to do its thing, but when England starts to do the socialist thing, it's always like, just one more nail in the coffin. From there, let's take a look at the euro. First, we'll look at the dollar, Turkish lira, and see what they're doing with that. There it is, right there. Still climbing up, and at the same time, as much as this broke down here, right there, it's trying to turn up again, right there now, at a very low end of the range. There it is right there. You see that now it's trading at, it still seems to be hanging around that 1730s area. It's not really threatening the 18 again. I don't know what they're going to do when it gets to 18 this time compared to the last time. Last time it got to 18, the government came out with a policy right there and knocked it down. They say that is one of their very important points where they try not to let the market get past it. And so that's going to be very interesting to see what happens this time when it reaches 18. Do they come up with another policy? I like the old one that they gave out, but somehow or another it seems to have fallen apart. And we don't even know what the little inside game has been. Now let's look at the Euro Turkish lira right there, which is kind of more of a, look at that. They finally did take that high out again, too, 2 days in a row. And that's holding up really well. It's in the 18s, still in the daily buy, still in the weekly buy. All the math is telling us that there's buyers coming in, lots of buyers coming in. All right, from the Euro Turkish lira, we jump over to the Canadian. And there it is right there. Now that's in a sell for 2 full days. This is the third day, and we're getting a volatility signal. Let's put that in there. And we're still up into the weekly buy, so the pressure is on. We do see oil kind of quieting down. You got to wonder if it's a combination of recession or what else could there be? The hope that more inventory is coming out the door, things like that. So they're selling the futures ahead of time when they know they're going to make a deal with Mr. Biden just to appease him, keep him happy. What a strange character he is. All right. Let's see. From there, we go and look at the oil contract. And there is, right there, that's the August contract. And, oh, look at that. It's perking up pretty well, actually, from yesterday. Let's see what the Brent looks like over there, too. There's Brent. I was going to say, I wonder if we had a big green popping up. Nothing yet. But you can see that the let's see, where's it trading at 106, and yesterday it closed at 103.41. So it's holding up pretty well here. We're seeing some strength in the August oil. Just let's see that normally with that type of strength we would see a Canadian. Do we have the Canadian up there again? Let's put it up on. Let's just put it over here. The Canadian is trying to lift. Should be really trying to head down. So it seems to be playing with this range, I guess you could say. And we're at the high end of the range, and it's not rolling over, which is kind of a surprise. Usually when it rolls over, oil goes up in price, Canadian becomes more valuable against the dollar. And we're not really seeing that here. And we'll see, because we're in that weekly buy now for a second week. Let's see what if that puts that energy. It's telling us that the energy is going to come in for it to go up. We did take out this high right here. That was a high of 30.76, and now the new high is 30.79. Not much of a difference there, but they did take it out. The classic technicians trading the the charts, I guess you could say, being proactive. All right, from there we'll take a look at gold, and we're going to look at the South African Rand. There's gold. It's down a little bit, and we're still in that sell from here. We had a red dot, that's why it didn't go into the buy. And now it's rolling over again, and the weekly looking kind of weakish, a little anemic there. It looks like it wants to keep on sliding and maybe get back into that weekly sell. And we always throw out the caveat, we really think we're going to see a better gold market going into 2023. So they may start jumping in the fall, after the election, or right before the election, things like that. All right. From there, we go over to the South African Rand. Because of the way gold is going down, we automatically assume that South African Rand is going up. And there it is, just a little bit, nothing major. Still in a daily sell for a couple of days here. And the weekly is trying to pierce itself on the upside. Let's put that in there like that. There we are. So there's that pressure on the South African Rand from the currency, or for the metals complex itself. Mr. Biden, they have him on the screen right now, blaming the blame game, they call it. Biden's blame game. Biden accuses gas station owners of price gouging. Poor Mr. Biden. All right. From there, we jump over to, I think that's the yen, I guess. We'll go take a look at the yen. Listening to Biden kind of makes me feel kind of exhausted. You see here the yen is trying to aim down a little bit right there. Let's see what it actually is doing over here. There it is. Yep, aiming down and getting ready to bust through the zero line, looks like. What is that? That's a 0.02. That could be the big peak. You would think that if that becomes the big peak, maybe we'll see a weaker dollar for a couple days, or maybe even a week or so. We're in a weekly buy there on the yen, so it's kind of hard. Once we get in, we're in that, let's see, daily buy, and it was a daily sell right there. Let's put those lines in there, and then we got a daily buy right there. We had the volatility situation, so the next day was the buy, really, right there, and has basically gone nowhere. Yeah, it's gone nowhere. Well, maybe this is the beginning of a rollover. That would make some sense. I would, as much as you've been here. At least I've been hearing the stories of Japan every weekend. How much there's a pressure on them to support their equity markets and their bond markets. There's just constant pressure on the country. They've been borrowing a long, long time since the 90s, and they've never really stopped. They've been doing quantitative easing now since the early 90s. So that is, probably the pressure point that has been pressing. That's why the Nikkei, which is, see if we have the Nikkei on here. The Nikkei's all-time high, let's put that up there. The Nikkei's all-time high is 39,000. That was back in like 92 or something like that, 1992, 93, something like that. Let's see, where's it at? There it is, September. And let's put it up on J4X. Maybe we can get the exact time period. Right there. No, they don't go back any further than 2003. So, it was. Oh, that's the yen. I'm sorry. Let's try the Nikkei. There. As it loads up. No, same situation there. But, at one time back in the 90s, this thing had hit 39,000. So, 39,000, you can see here we've been flirting with the 30,000 area. So that's not too bad. We're only 25% off the all-time highs. So that's pretty good. I mean, I'm not even sure what the Chinese market is at this point in time, but last I looked, it was about 45 to 50% down from all-time highs. So a lot of pressure on the Asian markets in general. In the end, if America is not participating with them, they don't have anywhere else to go. I mean, the European Union can't pick up the slack. They're hoping India does, but the income level's too low. So, China and some of these Asian states can really use the American market. Happy to have them coming in and buying. There is a Japanese index too. Let's see what that does. I guess that's the same thing. Huh. There's the day. All right. So that's the yen. That's the Chinese, the Japanese market. Let's jump over to the Mexican peso. There we are. And there's the Mexican peso. Let's put it up over here. Looks like it's still playing with that 2-3 from yesterday. That's the Fibonacci sequence 2-3. There we are. Yeah, it's still flirting with it. Touched it again today. It's underneath it. We're in that weekly buy for a second week. It doesn't seem like it wants to roll over. The Mexican peso, I'm kind of thinking it might try to do that bounce again, get through the 50 percentile. How it stalled out at the 50 percentile right there for 3 days. And maybe they get a little bit more energy into it. Maybe it gets pushed up or it just hangs out down here. Like I said, there is a lot of sideways, conviction. We don't see a lot of desire by money managers to really jump back in. They're trying to nibble away, lower their cost average, but not with any big chunk of money. The marketplace itself is kind of quiet. All right. Let's go over to, that's the end of the currencies. If anybody wants to see a currency, just shout it out. We will go look at it. Now let's go over and take a look at the metals complex. So there was gold, and it's having its pressure now from there. And it's been in the sell here. I couldn't get into the buy because it was in a red dot. And then what happened was it rolled over as usual. And you can see here the weekly is doing its best to push down. Now let's take a look at the silver. Silver went into a sell yesterday, and you can see it's still rolling over, and it's been in a long, what's that, 2, 4, 6, 8, 10. This is the 11th week now with silver in a sell. It looks like it's making its little slow leak down to the $20 area. Just when you think that maybe one more time down, bring in some buyers, and then maybe we get that action going into the election, and then we see some firmness going into January, and next thing you know, the metals are doing better. All right, so now let's take a look at let's do copper. There's copper. Still leaking down. We thought we'd see the 87. Yesterday's low was 88. Today's low is 83.5. So we're definitely down into that low end of the range we were expecting for. We'll see what kind of bounce we get out of it. I thought for sure we'd see the low 90s to the mid upper 80s, like 87, that type of thing, maybe even 86. But here we are down to the 84 area. So that's the 384. This product has been in above the $4 area for over a year and a half now. And if the world economy is slowing down and businesses in America are slowing down, then money won't be being bought in China, and then China won't be pushing. In other words, we are their number one customer. So they need us to buy. If we don't buy, they don't grow. Now, I heard that Xi Jinping, President for Life, said that he's going to, he's fighting for 5.5 GDP. So, I mean, they'll invent a number, and that'll be it. People will take it and do what they may with it. But it's an invented number. They don't really show you the internals. We can't, not like when we see them here in the States. They kind of hide that stuff. So, makes it tough to take that economy serious. Why anybody would think it's the second largest economy in the world, I have no idea. It seems like pure propaganda. I would think that I know the European Union is 21 trillion, so it's obviously at least third to that. But then at the same time, I would have to say that it could be number 3 or 4 or 5. It's hard to say when you look at Japan, or you look at Germany, or you look at England. But maybe China is the third largest economy in the world. Maybe it's not. I don't know. I mean, it's a good example, I guess, is in many ways the Indian economy. They have about the same population. What is the GDP of India? Let's see what that is. I bet it's like 2 or 3 trillion. I don't think it's much bigger than that. India GDP 2021. 3 billion. 3 billion? Must be 3 trillion. According to IMF World Economic April, India's normal GDP in 2021 was projected at 3 billion at current prices. This projection would make the billion? I would think it would be trillion. The 6th largest economy globally. Well, if India is the 6th largest economy, then I would have to assume that you have to figure that China could be the 7th, it could be the 4th, it could be the 5th, but it's not a leading economy. I mean, they're just spending all their profits on weapons and torturing everybody, teasing Taiwan constantly, threatening America constantly. It's kind of disappointing that they pull those shenanigans. So that's probably why we're seeing the copper weak, is that they don't really have that. They don't have that market. There's not that market at this point in time to perk it up. And if Americans are not buying, then China's not growing, or let's put it this way, not making money. And that is truly one of the big concerns, I'm sure, is the fact if they're not doing it, then they're not going to grow. Oh, hold 1 second. Just had to grab that text real quick to answer it. Yeah, so I mean, when we see that, India's over 1 billion people. So, like China, and actually, I think their income is higher than China too. So, in other words, per person, I think India is like 13,000, and I think that China is something like almost 12,000. So none of it makes any sense to me, but I just, we just watch it, we see how it plays out, and we go from there. So now, at the same time, we go over and we look at, let's see. So I guess that we talked about it yesterday too. Is that there's the concern. We showed you the headline. They need to deal with Greece. They need to deal with Italy. They need to deal with Portugal and Spain. They've got some financial situations there that make it very tough for the European Union to do one or the other. They have to help the states like those, or try to prop up all of the European Union itself. So it's a battle. They don't have the ability to do both. All right, from there we'll take a look at the platinum. It's going to kind of towards the end of the week here. Platinum right there. You can see platinum is moving down in a weekly sell for 3 weeks, so the pressure is on. And platinum has been a real good tool about leading where they're taking the currencies, not the currencies, the metals themselves. So at this point, platinum is weak. So we're assuming that it almost looks like they'll play with this bottomish area. Here it's been that way for a while. They just kind of hang out in the $900 area, and it seems like the floor. I'm sure that they can get a little below it into the eights, but I would have to think that money comes rushing in when you're looking at 1,000-point difference between gold and platinum. All right, from there we'll go over to the energies. Where is it at? Right. Well, there was crude. We looked at the August contract, how it's moving up. Let's take a look at the October contract. Both are in sells on the daily sell. So, there's some lagging going on there. And if the world economy is slowing down more and more, then, of course, we're going to see prices drop back down again. Maybe they'll break to the 95 area or something like that, 92 area. Now here's Brent, and there is a good wide spread between Brent and spot West Texas. It's trading at 111 and change, and Texas is trading at 6 and change. We've seen where at one point it got down to about $1.50, something like that. So the spread has widened back out more. And let's take a look at, let's see, from there we'll go to natural gas. There's gas. That's the front month, which is getting ready to expire. And I think it expires on Monday or something like that. Friday could be the last day. I think tomorrow could be the last day. And you can see here it is right there. Trading at 670 as you see it on J4X. And then let's go back to the September contract. Or no, I guess it's the August contract. Here's August contract right there. And it's trying to lift up a little bit more firmly, but still in a sell. And that's trading also in the 670s area. Now, we saw yesterday the European natural gas right here is trading at under the 27 area. I understand. I saw a headline they were talking about trying to fix it. I don't know how they can fix oils, but you can see here we're still sitting in that basically 26.5 area. And price fixing never seems to work. I don't know why. They repeat themselves over and over, thinking that they're going to get a different conclusion. But price fixing never really works. You can see there, Nat Gas August has been in a weekly sell for 2 weeks, whereas the spot right there is only 1 week. Oh, wait, here we go. There's the August. No, they're both in that way. Okay, that was oats. That's what confused me. Back month oats are in a weekly sell for 2 weeks. Front month oats are going into a sell this week. That's what it was. That was in my head. All right. So that's, let's see, nat gas, European nat gas, crude oil. We can take a look and see at what's going on with the fuels for machines. Let's take a look and see there. There's Robo. So that goes into the automobile. That expired about, was that 20 days ago? We need to put the other contract in. There's August. Right there. So there's the back month. They're just hanging out in the 376 area. That's today. You see it's in a buy, and it's been in that long weekly buy since January 8th. So what is that out there? We've been hearing some different birds that we normally never hear. It's kind of odd. We're working with the window open, and it is amazing. But there it is. There's the natural gas. Now let's take a look at what they put into diesel and check that out. Oh, here we go. We got some questions. I love it. Hey, when you said you made some millions of dollars on one option trade in that case, who lost the money? Well, in options, there is a second side, like everything else. For every buyer, there's a seller. For sure, the stockholders lost money because the stock went from 190. It was Juniper, so I think Juniper went from, was it like one? I think we had like the 170-80s put spread on, and so we had a back spread on. So we had we were short something like 2,700. Was it that, or we were long? Yeah, we must have been short like 2,700. Like 190 puts or 195. I think the stock was trading at 205. I think that's how it was working. And then we were long the 175 or 180 puts. We were long like about 3,800 of them or 4,000 of them, something like that. So it doesn't always work that way. So see, they've removed the zero sum factor options. So yes, because one person is winning in options, doesn't mean that someone else is losing. Whereas in stocks or the hard delta itself, futures contracts, usually a naked buyer of calls or puts, and the put, let's say whatever product it is, and the option makes money, the opposite side has a better chance of losing. But in options, you don't know, and I'll give you an example because it sounds like a free lunch, But imagine this: someone comes in to buy options, to buy the calls. Now traders sell the calls, that makes them short. Okay, they go buy, or in this case here, they sell calls, and then what they may do is go and buy stock. So now they're long stock and short calls, and that's a buy right. The underlining. Okay, so if it turns around and falls down, they can buy puts to hedge themselves. And what they were doing is they were selling on the offer, so they have a price advantage. Now that the prices are tight and they're not steens anymore, it makes it a little bit tougher. But that does not necessarily mean that they're naked. So in other words, I go in and buy puts, and the trader sells me puts. I go buy, and then I go sell puts of a different strike price, and now I have a big position on. It's like a binary, but it's not a 1-to-1 ratio. It's called a back spread, where you try to make it like dollar neutral or something like that. So you might be short 2,700 and then long 3,900, that type of thing. So that makes it neutral price wise, what you paid for it. Then the people who sold it to you and bought it from you maybe be doing the opposite thing the same way, and you're not necessarily getting long or short as much as you're putting a position on. So it's not like where if everybody is buying a stock or a future and someone's selling it, there's much more pressure. That's more of a battle. The battle is drawn right there. With options, they're not as committable. You can buy equal delta to make them like that, but it doesn't work that way, really. It's a. Does that make any sense to you? So in other words, it's not a free lunch, but what it is that they have their position and they put it on, and it's not necessarily the same position you have on. In other words, the people I sold the puts to may not have been the same ones that bought the other options. I think we legged it too. But, you don't know if they're already exist. Option trading is a lot more, I want to say, safer. It's just easier and better because you don't have to take the risk. And you don't have the margin problem that you have in the others. So it's just different. Whereas if you're in like a trading where you're buying it from somebody and someone's selling the stock or future, there's a lot more pressure on them because instantly one's going to be a winner and one is going to be a loser. But if you do it in options, you don't know if the ones that are fulfilling the order have a position on already. And so it doesn't make them losers. It just means they may have unwound some of their position, took some profits. Does that make sense to you? If you made it on like a single position like that, who loses? Okay, I explained that. Liquidity provider. What a liquidity provider, or what they call the market maker or the local. Again, you don't know what kind of existing position they have to make that market to begin with. In those days, people had positions much more on than they do today. They try to get in and out of them. So in other words, they come in today's markets. I go out there and I go buy 2,700 puts, or in this case here, I started off by selling 2,700 puts. I think I bought first and then sold. But either way, you go and buy the 3,900 puts. Someone on the floor or a group of people sell it to me, and then they may own them already, or they'll hedge themselves, so they're neutral again. They're not like taking the opposite side position. So when you're trading a stock or a futures, someone is really taking the other side of the position. In options, because of the lack of risk in them, the delta and so forth, because it's nowhere near as the hard delta risk is. So they may be selling. Now, I guess you could say, okay, what if you go in and buy a stock or a futures, and maybe they have that position too? That's true. That's a possibility. But it doesn't work exactly the same way with the hard delta, the underlying product, compared to the options. Let's read more of that. So I'm not sure if the streamer can see the chart. Oh, which chart is that we're talking about here? Let's see. Kimbo says, I just can't fully grasp how the money gets transferred from losers to winners. It's not direct, right? Correct. Because in options you can have neutral positions. You might be playing for a dividend. So you're holding on to a position just to collect the dividend, and someone comes in to buy the options, you may liquidate some of your options. So, in other words, they come in and buy them, you sell them, you were long them. If not, then they can go and put another position on. You can build neutral positions and then work your way out of those neutral positions. So what do you call it? You facilitate the trade, right? And then at the same time, you put a neutral position on. You don't have to put a bullish or a bearish position on. You have the choice as an options trader to adjust your deltas however you want. And that's what the difference is. All right, so let's see. Let's see. A little bit. I might have to rewatch this like 3 times to understand it. It's okay though. Okay, that's no problem. You're a gold mine of knowledge. Okay, thank you. Yeah, well, I've been saying that on the web. Not that I'm a gold mine of knowledge, but we really are disappointed. We assumed in the late 70s and early 80s, 1970s and 80s, we assumed that options would be a real main theme and move away from the margin risk of just the underlying product, in the next couple decades. That's what we thought back then. So we thought by the late 90s, going into 2000, people would be trading, and instead of buying 10,000 shares of a stock and holding it, you would instead be buying calls, and or you would be buying puts and buying the stock and selling calls against it, like doing what they call a reversal conversion for the dividend. We really didn't think that, and we have seen it. Option growth is greater than anything else volume-wise than anywhere else. So in other words, since quantitative easing, what is it? It's the New York Stock Exchange has lost about 50% of its volume. I have to say that the Nasdaq has picked up its volume, but it's also at the expense of the New York. The New York was doing 2, 3, 4 billion shares a day. Now it does like 1 billion shares a day, and the Nasdaq, on the other hand, does 3, 4 billion shares a day or 5 billion shares a day. So they've basically taken the volume away from the New York. The currencies trade about 45-50% less in volume than they did during QE. And there was a point where Nasdaq wasn't doing it at all either. They were both down pretty hard. Nasdaq has really picked up, especially in the last 4 or 5 years. But we've also seen New York lose it. Trying to think what else. That's pretty much it. I mean, we've seen a lot of diminishing volume with the QE. Let's see. So what about CFDS or futures? When you make money, who loses and how it works? Well, again, it depends on who fills the order to you. If they're taking the other side, or they have an existing position, or they hedge themselves when they facilitate the trade. So that's how that works. See, before options and futures, before 1975, basically 1976, okay? What happened was that most times when you went and bought a stock or a future or something like that, that meant that the other side had to be selling it from being long. They already owned it, or they had to short it and hope to buy it back. It was one or the other. That was it. They couldn't have a neutral position on, because when you owned these products, you could, there was the classic, back then there was the classic hedge fund concept of, you own General Motors and you sell Ford Motors, or vice versa. You're betting on who's going to do better, or outperform each other, or vice versa. You own Ford and you sell General Motors. And same thing with BMW versus, say, Mercedes, that type of thing. Frigidaire versus Whirlpool when it came to refrigerators, or washing machines. In other words, you would take the opposite side. I remember a time when they would buy UPS, the delivery service, and sell Federal Express, the other delivery service. In other words, you would pair them off. You might buy one gold company and sell another gold company, thinking that who's the better management and who can outperform. That was the only thing that existed for a long time when it came to hedging or pairs trades, was they would go and do those things. Okay? Maybe they would buy some warrants and short the stock at the same time at the right delta. They had the same thing. A lot of bonds, a lot of corporate bonds offer a call option on their stock, their equity stock. So in other words, when you buy the bond, now you are also long stock in a sense. So you short the stock. That's a hedge of it. So that's in these times now, the participation in the option market is so enormous that they could have existing positions, or they can put on an existing position to make themselves neutral. So in other words, we're option providers, you and I, and a bunch of other people standing on a trading floor or in an office now providing liquidity. And then what happens is someone comes in and says, "Hey, I want to buy a 500,000 options on this particular thing, a half a million calls." So everybody, bunch of us, you, me, and everybody else goes and sells them those calls. Well, I might be selling them because I have a straddle on to begin with. So all I'm doing is liquidating my position a little bit, taking it off for a profit. For yourself, maybe you want to just facilitate. You're not trading an option position. You're just facilitating the trade. So then you can go and hedge yourself. You sell them the calls. You're long the call. They're short the call. Or no, in this case here, you sell them the calls. You're short the call now. You can go in and buy the stock. Now there's a premium in the option, so that can compensate for, if let's say the equal delta, depending on this delta of the strike price of the option, it might take 3 options to equal 100 shares of stock, and so you could adjust your deltas that way. But you could be neutral. So you could sit in that position for a day or two, neutral, and not take any risk at all. Does that make any sense to you? And so that's the difference between option trading versus the underlying product, be it a future or forex or the stock. That's the difference. Is that just because you took the other side doesn't mean you're going to be short. You could also become long with them. Okay, yeah, and that's really the truth of it all. Let's say a trader comes in, buys calls. All right, so now that trader is long. Okay. At the same time, us, you, me, and a bunch of others sell him or her that call. Now that makes us short. We can instantly buy stock against it, and now we're neutral. So we're not really short. We may be, and depending on how you do it, you could actually be long also. You could actually be long at the same time. What happens if someone else comes in at the last moment and wants to sell other options, and it's a different participant? All of a sudden, you might have a binary on, or a back spread on, or you just don't know. I hope that makes sense. Let's see. I will. Let's see. Where am I at? Where's my mouse? There's the arrows in the way. I will bombard you with questions, probably upcoming streams too. I want to full understand how all financial markets work. You're welcome to. To be honest, it's not that complicated to me because I've done pretty much everything. So I'm sure there's something I haven't done. I'm sure of that. But, pretty much I've traded options, at every level, from the amateur to the professional to the hedge fund industry, institutional. So in the end result is that it all comes down to how you hedge. I mean, you could actually, someone buys calls from you And at the same time, the way you hedge could make you long right along with them. You could be short the calls you sold them, but at the same time, you could automatically go buy the underlying product and neutralize yourself instantly. You could actually, if you buy enough of it, you could be long just like the call buyer. But the thing is that you really never know what the other side is truly doing. In other words, just because they come in and buy calls doesn't make them long. I can tell you this. There was at one point, I was working out of Connecticut and at the brokerage house, and I guess somebody was facilitating trades for Paul Tudor Jones, and we could see a lot of his trades. And the news media would tell you, oh, Paul Jones, Tudor Jones just bought 5,000 futures contracts in oil. And at the same time, we saw that he would go out and buy puts. He might buy like 7,000 puts. The media would just tell you that he's long the futures contract. They wouldn't even mention the puts at all. So in other words, to be honest, if they really wanted to report what they knew about Paul Jones, they would have said he put a straddle on. That's a straddle. When you buy puts, more puts than you buy underlying product, that becomes a straddle because you can make more money on the downside. Imagine if it crashes, you got all those extra puts compared to 1-to-1. So in other words, if he buys 5,000 of futures contracts, but he bought 7,000 puts, then he's basically has the potential to be short overall, not long. But they make it. The news media would make it sound like he's long, and we knew that he put on puts. Matter of fact, sometimes we saw him put on extra puts the next day, so even more. So he had a really big straddle on in essence. And so that's the whole thing about it in the end, is that you really don't know if if he was coming in and buying 5,000 futures. You don't know if he was closing. He might have been short them and now he was closing it out by buying them. In our case, we knew sometimes he was doing options and the underlying futures contract. So, let's see. What's the biggest difference between amateur and hedge fund professionals? Well, amateur, just less money and less, I guess you could say dedicated. A hedge fund is going to be working the markets 24/7 almost. They're going to be looking at their positions all day long. They're going to be working their positions. They're going to try to take less risk. They have a lot more money. And an amateur usually might just buy calls, not buy binaries. They might or buy puts and not buy binaries. In other words, buy a put and sell another put of a different strike. They may not do the hedge side of it. The difference not necessarily is professional versus amateur, but it's the style that they trade in. Are they trading straddles? Are they selling straddles? Are they doing butterflies, which are a very neutral position, have a very minimal loss factor? You're trading for 10 cents to make $1.50 with a butterfly. So you're playing like a 15-to-1 ratio risk. It's just, that's probably the best way to describe it. It's not as much as that they're amateurs as that they just have a different motivation. Whereas the hedge fund, they're trading borrowed money from investors, so they need to generate a certain amount of income and so forth. I want to become Paul Tudor Jones. Been trading for 3 years now. Okay. I traded a little bit for a prop firm. Okay. Well, I'm not sure if it was Kimbo, was it you that I was telling? Someone asked me what books to read a couple days ago. I don't think it was you, was it? Was it you that asked the question? What books I recommend? But I'll go through it again, and I would say read Larry McMillan's book of Options as a Strategic Investment. And you can read the old ones. Okay, good. So if you read the options book, read it a couple times, and then you can ask me questions about options that way pretty easily. Then you read John Murphy's book on technical analysis, and some W.D. Gann and some R.N. Elliott. You're going to understand pretty much between John Murphy's book. He goes through, it's like the encyclopedia of technical analysis. So John Murphy's book is going to give you a flavor of almost everything. And it's probably going to mention W.D. Gann. It's going to mention R.N. Elliott. Then I suggest read that work with the Fibonacci even more. Read it again. Independent from the original authors themselves. And then you can try to, after you get comfortable with a simple book of Larry McMillan, you can look into more sophisticated. It's not going to be too much, because all he's going to do is talk about interest rates and the dividend and how to have a neutral position and put positions on that almost cost you nothing, things like that. So that's no problem, and I have no problem talking about this. I think it's important. Like I said, we as traders really were hoping that the markets would turn into a option market in the end, not the underlining. So in other words, when they're worried about the stock index being up, 3% for the day, or 1%, or 0.5%, or down 0.5%, we really would have been happier to see the markets move away from that as much as move more towards utilizing a more neutral, less risk-orientated position. That was our hope. That was our dreams. It was the late 70s. It was the early 80s. We had time on our hands when you're standing on a trading floor when it's not busy, or if you were in a busy crowd, then you didn't really have an opportunity. But when it was slow, and you were like trading very conservatively, and facilitating trades at the same time, you had time to think about things like what we're talking about right now, and how it works. So that is that. I hope everything worked out fine there. Does anybody want to see anything else? If not, we'll get out of here. The New Yorker has opened up on me already for about 2 minutes ago. But I find the conversation more important than me doing a flip trade here or there. And I don't like the first 10 minutes anyway. I just like to be prepared. That's usually the way it goes. All right, then. This is Doc from North America. Always glad to answer your questions. If I don't know where the answer, maybe Robin does. And if Robin doesn't know it, the two of us together can figure out where to find the answer. That's usually the way it goes. So, this is Doc from North America saying, happy trails to you until we meet again. Happy trails to you, to all our trading friends. It's one or the other. If I don't know it, then maybe Robin knows it. And if Robin and I don't know it, then we know enough to find out where to find the answer. That's usually the way it goes. So, we be out of here. Happy trails, traders. Be safe. Catch you tomorrow on TGIF. Thank goodness it's Friday. And thank you, Kimbo, for asking a good question. Like I said, it's always cheaper by the dozen. At least ask a dozen as far as I'm... As a matter of fact, let's count it up before I leave. How many did you ask? I like that. I like how you responded. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Good. 17, 18, 19. Very good. 19, 20, 21, 22. You needed 2 more questions that make it 24. Remember, it's cheaper by the dozen. And then once you're done 1 dozen, you start over again. Ta-ta, traders.